August 2005. A 74 motorway near Cleftchen, Scotland. A white van drives north through Dumfries and Galloway. The driver stays exactly at the speed limit. But Scottish police pull it over for a random check. The driver shows his license. Everything seems legitimate until officers ask to inspect the cargo. Inside the van, boxes. Hundreds of them, all branded with logos everyone recognizes: Calvin Klein underwear, Nike sportswear, Prada accessories, Lacoste polos, Walt Disney merchandise. Retail value, if genuine, over £1 million. But these aren't genuine. The stitching is wrong. The labels are slightly off. Every single item is counterfeit. The driver claims ignorance, says he's just making a delivery to a Glasgow wholesaler. Police arrest him anyway. They photograph everything, document every brand. What they don't realize, they just discovered the distribution network of one of the UK's biggest tax frauds in history. And the man behind it is 300 miles south in Preston, sitting in an office on Fishergate, running a company called Faisaltex Limited. His name is Arif Patel. To his neighbors, he's a successful sock manufacturer, a legitimate businessman, someone who made it. Behind that facade, a criminal mastermind building an empire worth £150 million through counterfeit goods and carousel fraud. Preston, Lancashire. Early 2000s. Walk down Fishergate in Preston city centre and you'll see Faisaltex Limited's offices. Professional signage, clean windows, the kind of place that looks entirely legitimate. Arif Patel, 37 years old, presents himself as a textile entrepreneur. His company manufactures socks. Basic stuff. Nothing glamorous, but profitable enough to explain a comfortable lifestyle. He lives on Sharrow Green Lane in Fulwood, one of Preston's better neighborhoods, drives nice cars, wears good suits, attends business meetings, pays taxes, or at least appears to. His brothers, Faisal and Munaf Patel, work in related businesses. The family runs multiple companies with similar names. On paper, it's a legitimate family textile business. Import-export, manufacturing, distribution, standard industry operations. But in 2004, Patel sees an opportunity that legitimate business can't match. Two opportunities, actually. Both illegal, both potentially worth millions. First opportunity, counterfeit goods. China and Turkey are manufacturing fake designer clothing at incredible quality. The counterfeits are so good that average consumers can't tell the difference. Import them in bulk, sell them as genuine, and the profit margins are astronomical. Second opportunity, VAT carousel fraud. This one's more complex, more sophisticated, and if executed properly, worth tens of millions. Patel decides to do both simultaneously. Use the counterfeit operation to fund and disguise the VAT fraud. Build a criminal empire hidden inside legitimate business operations. He just needs the right partners. 2004. Patel makes frequent trips to Dubai. His partner there is Mohammed Jafar Ali, 46 years old. Ali understands something crucial. Dubai's banking system and free zone companies offer perfect vehicles for money laundering. Here's how their system works. Patel sets up British Virgin Island registered companies. These are shell companies. No real operations. Just legal entities that exist on paper. The ownership is obscured through layers of corporate structure. When money from the UK operations needs to be moved, it flows to Ali's Dubai accounts. Ali manages free zone companies and offshore bank accounts specifically designed to obscure money trails. The cleaned money then flows back to purchase property. Not in Patel's name, in the names of the shell companies, properties in Preston, properties in London, commercial real estate on Fishergate, residential homes in Sharrow Green Park. But they also invest internationally. Property in Morocco, property in the United Arab Emirates, property in Saudi Arabia, property in Turkey. It's not just about hiding money. It's about building legitimate-looking wealth that can't easily be traced back to criminal operations. Ali becomes Patel's trusted financial enabler. Every trip to Dubai includes meetings to coordinate the money flows, to adjust the system, to stay ahead of investigators. 2004. Patel begins the counterfeit operation. He travels to China and Turkey personally. These aren't tourist trips, they're business negotiations with manufacturers who specialize in producing fake designer goods. The manufacturers are sophisticated. They have the patterns. They have similar fabrics. They can replicate logos with impressive accuracy. The only giveaways are subtle, slightly wrong stitching patterns, marginally different fabric weight, logos that are millimeters off-center. Patel negotiates bulk orders. Entire shipping containers full of counterfeit clothing, socks, underwear, hats, pajamas, t-shirts, all bearing fake labels from 35 different designer brands. The manufacturers pack the containers carefully. They mix counterfeit goods with unbranded items to avoid detection. If customs inspects a container and sees mostly legitimate unbranded clothing, they might miss the fake designer items hidden deeper in the load. The containers ship to UK ports, Liverpool, Southampton, Felixstowe, different ports for different shipments, never the same pattern twice. Most containers clear customs without inspection. The UK processes thousands of shipping containers daily. Customs randomly inspects perhaps 5% of shipments. The odds favor getting through. Between 2004 and 2007, Patel successfully imports dozens of containers. Each one contains counterfeit goods worth over £1 million if they were genuine. The distribution network is already established. Wholesalers across the UK. Small retailers who don't ask too many questions about why designer goods are so cheap. Market traders. Online sellers. The counterfeit operation generates millions in profit, but it's actually the smaller part of Patel's criminal enterprise. The real money comes from the VAT fraud. Here's how carousel fraud works. It's complex, sophisticated, and, when done correctly, almost invisible. Step 1. Create a chain of companies. Patel controls multiple businesses, but on paper, they look independent. Faisaltex, Morville Trading, Oakville, Faisal Imports. Each company has different directors, different addresses, different bank accounts. Step 2. Move goods between these companies. Except the goods don't actually move, it's all on paper. Invoices showing Company A sold textiles to Company B. Company B sold them to Company C. Company C exported them. Step 3. Claim VAT refunds on the exports. When Company C exports goods, UK tax law allows them to reclaim the VAT they paid to Company B. The government refunds the tax because exported goods aren't subject to UK VAT. Step 4. The crucial part. The goods never actually existed. Or they existed but never actually got exported. The entire chain is fabricated. False invoices. False export documentation. False shipping records. The tax authorities refund the VAT based on the paperwork, except the VAT was never actually paid. The whole transaction was fictional. Multiply this by hundreds of transactions, each one claiming VAT refunds on supposed exports of high-value textiles and mobile phones. Between 2004 and 2006, Patel's network files claims for £97 million in VAT refunds. HMRC stops £64 million of the claims. Their fraud detection systems flag suspicious patterns. Too many exports from companies with no real trading history. Invoice amounts that don't match typical industry standards. But £33 million gets through. £33 million of taxpayer money flowing into Patel's network based on entirely fabricated transactions. Complex fraud requires professional help. Patel recruits 2 chartered accountants from a Preston-based practice, Anil Hindosha, 69, and Yogesh Patel, 66. These aren't street-level criminals, they're respected professionals with decades of experience. Here's what they do. They generate false accounting records for all the Patel family companies. Every fictional transaction between Faisaltex, Morville Trading, and Oakville needs corresponding ledger entries. The books must balance. The numbers must look realistic. They manufacture invoices that appear entirely legitimate. The formatting matches industry standards. The amounts fall within typical ranges for textile transactions. The payment terms look standard. VAT calculations are mathematically correct. They create export documentation describing transactions that never happened, bills of lading showing goods shipped to European buyers, customs declarations listing high-value textiles leaving UK ports. All fabricated but professionally formatted. The genius is in the details. Real export paperwork has specific characteristics, certain stamps, particular reference numbers, sequential document IDs. Hindoka and Yogesh Patel replicate all of it. They're not doing this out of ideological opposition to taxes. They're doing it for money. Patel pays them generously for their expertise. They're cut hundreds of thousands of pounds for helping facilitate tens of millions in fraud. But they're also building the evidence that will eventually convict them. Every false invoice carries their fingerprints. Every fabricated export record can be traced to their office. Every accounting manipulation gets preserved in digital files and paper trails. Professional criminals often make one critical mistake. They document everything too well. The same attention to detail that makes fraud convincing also makes it prosecutable. Between March 2004 and April 2007, HMRC seizes 39 shipping containers at UK ports. Each seizure follows the same pattern. Customs officers open containers, supposedly containing legitimate textiles or unbranded goods. Instead, they find thousands of counterfeit designer items. Socks bearing fake Calvin Klein labels. Underwear with fake Armani branding. Hats pretending to be Nike. Pajamas claiming to be Disney merchandise. The brand companies get called to inspect the seized goods. Representatives from all 35 brands examine the counterfeits and confirm these are fake. The stitching is wrong. The fabrics are substandard. The logos are slightly off. Each container represents over £1 million in losses to legitimate brands if the goods were genuine. 39 containers, approximately £39 million in counterfeit goods intercepted. The seizures happen at different ports: Liverpool, Southampton, Felixstowe, different entry points for different shipments. Never the same pattern twice. But here's what HMRC doesn't immediately realize. The counterfeit operation and the VAT fraud are connected. The same network, the same criminal enterprise. The containers aren't just evidence of trademark violation. They're evidence of a much larger conspiracy. The seizures start mapping the network. The containers are addressed to various Patel family companies. The documentation shows connections between Faisaltex, Morville Trading, Oakville, and others. One container arrives addressed to Morville Trading. The next week, a shipment for Oakville, UK gets intercepted. 2 weeks later, Faisal Imports appears on seized documentation. Different company names but the same Preston addresses, the same contact numbers, the same banking details. Investigators begin connecting dots. These companies keep appearing. The same family names running different entities. The same addresses in Preston showing up repeatedly. The same shipping patterns from China and Turkey. In 2005, the van stop in Scotland adds another crucial data point. A driver working for Patel's network, transporting counterfeit goods to a Glasgow wholesaler. Every seizure adds to the pattern. Every interception reveals another connection. By 2007, investigators have enough evidence to understand this is massive, coordinated, and worth investigating with serious resources. Lancashire Police and HMRC launch Operation Mimosa, a joint investigation targeting the Patel network. The operation is massive. Investigators analyze years of shipping records, thousands of invoices, bank transactions flowing through multiple accounts, property purchases through offshore companies. They identify 26 people involved in the conspiracy, not just Patel and his brothers, drivers, warehouse workers, accountants, money laundering facilitators, each person playing a specific role in the operation. The investigation takes years. Forensic accountants trace money flows through complex corporate structures. Computer specialists analyze digital records from seized hard drives. Interview teams question dozens of witnesses. Each piece of evidence must be documented, verified, cross-referenced. Between 2011 and 2014, investigators conduct multiple trials. 24 gang members get convicted in 5 separate proceedings. Total prison sentences: 116 years and 7 months. The trials happen in waves. Lower-level operators first. Drivers who transported goods. Warehouse workers who stored containers. Each conviction builds evidence for the next trial. Each cooperating witness provides testimony about higher-ups in the organization. The accountants get particularly harsh sentences. Anil Hindoka, 12 years and 10 months for false accounting, conspiracy to cheat the public revenue, and money laundering. Yogesh Patel, 5 years and 7 months for conspiracy to cheat the revenue and money laundering. Other gang members receive sentences ranging from 18 months to 8 years depending on their roles. Some cooperate and receive reduced sentences. Others fight the charges and get convicted anyway, but the masterminds remain untouched. Arif Patel and Mohammed Jafar Ali aren't in the UK anymore. They're watching from Dubai as their empire collapses, as their employees and facilitators face justice, as investigators freeze millions in assets. They think they've escaped. They're wrong. They've just delayed the inevitable. July 2011. As Operation Mimosa closes in, Arif Patel boards a flight to Dubai. He tells family and associates it's a business trip, standard operations. Meeting with Ali to discuss financial arrangements. Nothing unusual. He never returns. Dubai becomes his permanent residence, the city that has no effective extradition treaty with the UK, the place where wealthy fugitives can live comfortably if they have enough money. And Patel has plenty of money. Properties across multiple countries. Offshore accounts. Assets hidden in shell companies. Even with HMRC freezing £78 million of his UK assets, he has resources. He watches from Dubai as his network collapses, as his accountants get sentenced, as drivers and warehouse workers and enablers all face justice. But Patel himself remains unreachable. UK authorities issue warrants. Interpol adds him to watch lists. They request extradition through official channels. Dubai doesn't respond. April 2023. Chester Crown Court. After 12 years as a fugitive, Arif Patel finally faces trial. Except he's not physically present. UK law allows trials in absence when defendants deliberately flee to avoid prosecution. Mohammed Jafar Ali initially attends the trial. He sits in court for most of the proceedings. Then on the 27th of March 2023, he doesn't show up. A warrant is issued for his arrest. He's fled to Dubai as well. Arif Patel, 20 years in prison. Mohammed Jafar Ali, 14 years in prison. But UK authorities aren't finished. Criminal convictions are just the beginning. The Proceeds of Crime Act allows confiscation of assets obtained through criminal activity. For 2 years, HMRC, Lancashire Police, and the Crown Prosecution Service worked together building the confiscation case. They identify every property Patel purchased, every shell company, every offshore account. Total restrained assets, over £90 million.